Okay, hello everyone, and welcome to this weekly trading roadmap. This is Miltos. I'm going to be going through the main event-driven risks that we might see this week, and effectively go through a bit of a theoretical risk and money management plan, my risk and money management plan, and then take a look at a few of the markets that we feel are actually going to drive some flow. We've already seen some particular flow coming into a Monday, some risk-off themes playing out in the market. I'm not quite sure if there's any sort of news event behind it. I more think it's more to do with the technical structure of the market and where it had closed last week. We went through some of these things in the weekly market wrap on Friday, and I'll just kind of reiterate some of those things again. So let's just first take a look at what we've got this week. Looking over here at Monday, we really don't have anything on the news front, just the German industrial productions. That is it. I've got that basically on a low relevance. But seeing as we're seeing quite a bit of volatility in the market, I'd say your weekly risk allocation should be quite evenly spread across the week. You don't want to give yourself too much risk on one day because of an event, because there's going to be volatility. You can see the markets are moving. Spread your risk quite evenly, and obviously leave yourself chips throughout the whole week. You do not want to, stop yourself out for the week on a Monday or Tuesday. 2 days into the week, you've got to keep yourself liquid. You need that liquidity to trade throughout the whole week. You never know when an opportunity will arise, and you've got to be ready to take it. So I'm giving myself 20% risk on the Monday. Moving into Tuesday with the U.S. wholesale inventories and the Fed's Lind, again, quite light on the data front. Low relevance, but I'll give myself a little less risk allocation. The only reason why I'm giving myself a little bit more risk allocation on Monday is because we've had some interesting setups in the market, which I'll go through in a second. Looking over to Wednesday, we've got the UK industrial productions and manufacturing production, the US budget statement, and then we have the Fed's Yellen, which is one of the main events of this week. She's speaking on Wednesday and Thursday. Now, this could give us a little bit more insight than we had even in the last Fed statement. So I would say keep in mind that she's got a chance to tell the market and guide the market with regards to monetary policy. At the minute, we have such a wide discrepancy where the Fed's been saying 3 to 4 hikes in a year, the market's saying no hikes this year. Right now, we're diverging so quickly, one has to fold. So we have to see something from one side or the other, and I think this is a very good chance for the Fed's Yellen to actually bring those market expectations in or move closer to the market. So please, do your prep on this, have your scenarios, and trade this with all the respect it deserves. After that, we've got the Fed's Williams as well. So overall on Wednesday, high relevance, 20% risk allocation. Thursday, nothing really on the data front, just the Fed's Yellen, which is the main event of the day. Again, high relevance, 20% risk allocation. Moving over to Friday to wrap up the week, we've got the German CPI and GDP. We've got the UK construction output, the European industrial production, and GDP. Then we move over to the US. We've got the import prices, and the main event, I think, for the week is the US retail sales. I would argue retail sales being way more important in terms of market volatility than the NFP number that we just saw last week. And reason being, just by market reaction, just by way of market reaction, NFP, when you have a certain move, let's say a blip down, it tends to reverse and we get a lot of choppy price action. That's a lot of what we saw on Friday. Retail sales, on the other hand, we have had situations where retail sales has invoked on the market a bit of continuation flow, which is what you want to see. And that just goes to show you that the market is paying attention to this figure. And as such, if you see any sort of moves and it's a big miss or a big beat, please, try and catch a bit of a continuation with that, because the market tends to pay attention to it. Again, retail sales on Friday, quite important. With the University of Michigan, consumer confidence, business inventories, and then the Fed's Dudley on Friday as well. Pretty high relevance, I'd say, overall on Friday. I'm giving myself 25% of my risk moving into the end of the week. Great, so we've covered the main event-driven risks. There's been some themes playing out in the market over the last couple of weeks. We're going to take a look at some of the markets. First and foremost, we're going to go through the weekly market profiles for the Bund and the stocks, the two main markets that I trade. And then we're going to take a look at some of the other markets that may be a bit more pertinent in your trading plan this week. We take a look at the Bund. Now, the Bund was very, very interesting, and we discussed this quite in depth on Friday, and we spoke about the fact that the price action in the Bund was telling us that it just really was gagging to go up. At this point in time, if you just toggle this split and take a look at how this looks, you can see we actually tried to make a move to the downside last week. We found a bit around last week's value area low, made a move to the upside, and just look at these buying tails that we put mid-weekly range. Guys, this is the kind of price action where you're saying, okay, there has been a passive buyer in the bonds, but that passive buyer has now moved his bids higher and higher. If you were watching the reaction over the NFP on Friday, there was someone sat at around 163, 163.38, if I remember correctly. 38. It was about 1,500, 1,700 lots sat there. The market came down to him. He got clipped for all of them, and he didn't even budge. The guy just sat there, maybe a few ticks offside, and within half an hour, he was already 20, 30 ticks on side. So there is passive buying in this market that's moving higher and higher. And the reason why we said, at least myself, I was feeling rather bullish in the bonds is because we had this one time framing break at 28s here. So 163.28, we took it out by 2 to 3 ticks, and the market had 0 sellers interested in coming into the market. This is a very big sign that these are longer term investment funds just stepping into the market. They're not stopping out after a daily low gets taken out. These are not weak longs. These are longs that are in for for the whole party in the Bund. They don't want to just hold it for the next 1 point. They're holding it on their portfolio. So this was quite an interesting observation. I think these 3 buying tails gave us the indication coming into this week that there was going to be some sort of buying interest in the market. You could see we opened up let me just remove this toggle for you guys. So we opened up very ever so slightly outside of last week's value area, as you can see here, 163.73. That goes down to 163.35. So this is our value area low. This is our value area high. We opened up just outside of it. You could see we found a bid around here, and now we're trading much higher at 164.34, taking out last week's high at 164.22s. So all in all, quite an interesting, I think, setup in the bonds. We also had what we call a 3-bar triangle in the bonds, which again, one of my favorite setups. I'm just going to toggle this again. The premise behind the 3-bar triangle is obviously this day in here closes within the 2 daily range, and you could see that 2 daily range from 164.22 down to about, I'd say, 25s ish. So this was our mother candle in here, and this day closed within it. So our 3-bar triangle, effectively, once you take out one of these highs or lows, you usually see some really decent flows, which we have seen already thus far in the day. So again, some really nice little consolidation patterns, some nice energy patterns where we've got some pent-up energy in the market, and there was some good flow, some good volume breaks. Hopefully maybe I can get that up on a price ladder stream for you guys so you could take a look at what that looked like. In terms of just the yield, I want to just pull that up again just to keep you guys posted. For those of you who don't have a yield chart, quite important to understand how we're moving at the minute. Again, we went through this on Friday in the weekly market wrap, and you can see that the market's come out of this 42 basis point mark. It's been sitting here in this range for a very long time. Took out this area and we just traded down to this 29.4 basis point mark, which saw ever so slightly some sort of price resistance, but we've now broken through that. And I want to make this very clear now. You have to understand, guys, that there is very little structure in this. This for me isn't a structure. This is some sort of price base that the market could pay attention to. You could see it paid attention to it here and here. The market is very unlikely to pay attention to any particular price bases or areas in which there's structure. This could very well make a move very quickly down in yield and thus higher in price. So ultimately, so long as we're using this area now as resistance, we can have a move down to this 5 basis point mark in the Bund. So just please, guys, keep an eye on these yield charts. They're quite important and pertinent in our trading strategies. One last thing that something I mentioned on Friday is our inflation expectations, and this is something to keep an eye on in case the ECB is watching this very closely, which I imagine they are. You can see 5-year inflation swaps have now taken such a big nosedive, down from about 1.8% in Q4 2015. Now we're trading around 1.5%. This is near the lows we've seen recently well, basically last year in Q1 2015. 1.4837 is the low that we saw in there. And we're trading very, very close to these levels. So remember, if the ECB thinks that inflation expectations are moving too low too fast, they might have to come in and bolster up their rhetoric to actually get the market believing that they're going to, kickstart inflation again. This is not a situation they want to be seeing, and this is again one of the ECB's preferred measures of inflation expectations in the medium term. Now, moving over to some of the equities, I'm going to look at the stocks, which the stocks was very interesting. We noted last week that we had a very bearish engulfing sort of week, as you can see in here. This week, last week, took out most of this range, and the value, this value area was much, much lower than the week before's, and in fact even posted a little lower than this week. So this overall, with our single prints, with the high of the week at the open of the week, and with a very, very bearish close, this gave us a very clear indication that there was possibly some more selling in this market. And I think that was something that we did note coming into the end of the week last week. So given that we're now trading much lower, we're trading around the 28.15 handle in the Euro Stoxx 50. These are our metrics. Obviously, we're a little bit further out now, but our value area high of the week at 29.48. Our value area high. Our value area low at 28.75, as you can see in here, the bottom of that orange slit there. We've now taken that out, and we're distributing, trying to find value in the lower region. Now this is particularly ominous for the Euro Stoxx, and I'll tell you why this is looking relatively ominous, and the reason why we have to keep this in mind is we pointed out at the end of last week, and we're looking at the Stoxx 50 cash market, and we said that this close was not looking particularly healthy. Given the way this structure is looking, we've got obviously our larger time frame. This is a weekly chart on the cash head and shoulders pattern. As you can see here, this is our left shoulder, this is our head, and this is our right shoulder in here. Sorry, I don't want to be repetitive. I've pointed this out quite a few times, but I think it's very, very important to understand this structure. We had the break. Since the break, we've mentioned if we're going to trade around this, we're probably going to try and battle this out. We've been battling this out. We've held below the neckline, as you can see in here, and we've had this very, very bearish engulfing candle. Now we've taken out this low, and effectively we're making our way down to this quite an important and critical low. As you can see, I'll just point that out for you guys in here at 27.89. Spot 63. So that level is the level, this drop that we saw in the end of 2014, quite a vicious little drop that we saw in here, but keep an eye on that level. Obviously, it is very important support, but again, if we take that out and we're not really paying attention to these levels, there could be a monstrous liquidation that we might see this week, and this is something, again, we mentioned in the wrap-up. We said if we start moving lower, all these guys that have been buying, and I remember even Sojan mentioning it in his morning stream on Friday, all these guys have been buying the closes, just out of hope that they're going to be on side. They've been put so far offside. There is a chance that we might see one of those vicious, 50, 60, 70 tick moves within a few minutes. Just really, guys, pay attention to the flow this week, because the flow, it's all in the flow. When the markets get this volatile, try and just scalp with the volatility. You have to increase some of the risk you take on these trades. You're no longer looking at 2 to 3 tick stops. You could be looking at 10, 15, 20 tick stops, and try and stick with the trend. Try and stick with the flow. The flow is the most important thing. So for those of you that trade on a price ladder, pay attention to the flow in the price ladder, because there's going to be paper coming into the market. When I say paper, I mean the funds. Last time we saw these kind of moves with really big, washouts and liquidations, it's not that hard to see in the price ladder. Someone often comes to market with like a 2, 3, 4,000 lot at market, and he just chases it down the ladder. And if you see that kind of desperation, trade in front of that guy. Don't, he's been stupid enough to be buying it up, literally averaging his nuts off over the last week/months, and if he's desperate to get out and he shows his hand, the market's not going to treat that hand very kindly, and neither should you. You should be trading with that flow. So yeah, this is how we're currently looking in the market. Obviously, we're yet to see how we're going to close in a week. We could very well bounce off of this level and close back above these key lows that you could see in here. But at the minute, I think overall the sentiment in the market is very, very much bearish. One market, one index that a lot of traders now are looking at, and we've been pointing this out for a little bit of a while now, is the Eurostoxx banking index. The banking index has been very, very weak. Banks that you should be taking a look at, obviously the Italian banks because of all their non-performing loans. So banks like UniCredit, Montepaschi. You want to be looking at obviously even the bigger banks, some of the behemoths in Europe, Deutsche Bank. So Deutsche Bank is looking very, very unhealthy at the moment. They took a really big loss in their last earnings, so about 7 billion euros worth of loss. So pay attention to these banks, even Standard Chartered. So these banks are getting hit. Now, whether this is really just a combination of what's on their balance sheet, how the market perceives it, if they got too much exposure, let's say Deutsche Bank's got something of the order of about 77 trillion worth of derivative exposure. This is something, just such an incredible figure. Obviously, that is such a big figure that if they ever got into a situation where they didn't have the liquidity or they couldn't post up collateral for something like that, and they had to liquidate quickly, that could be an another Lehman moment, effectively. So I'd pay attention to these banks, Deutsche, Standard Chartered, even the Italian banks, which are not as big but very important to keep an eye on. The banking index, as you can see, we did come off ever so slightly from this 97 level, which was a weekly level. As you can see, we had a bit of a bounce, closed a pretty bearish candle, as you can see, on Friday, and now we're moving right back down to that level. To keep an eye on what this looks like on a weekly. So you could see on the weekly, just erase some of this stuff for you guys. So this is currently what we're looking like. I just want to make very, very clear that these lows in here that you can see are the global financial crisis lows, 84.7. And these are the lows from the European banking crisis. So 71.9 is in the mid of 2012. This was in early 2009. We're now trading very, very close to these areas, and in fact, this is a very, very important support at 97. Through these 97s, really, we could start testing lower towards these 84.70s, and effectively through there, we might be looking at these 71.90s. So at the minute, the Eurostoxx banking index looking very, very, very weak, and I'd really, guys, pay attention to this. There's a number of things now to pay attention to. We've got oil on our radar. We've got the yuan on our radar. So if we just pull that up, just to see how we're actually looking. Obviously, last week we had a very big move in the dollar, a lot of dollar weakness. That's obviously brought some of the yuan weakness out, which we saw. As the yuan was weakening, we saw a lot of equity weakness. But now this is not really the driver anymore. We've got a new driver. It seems as if we've seen a lot of CNH strength in this move to the downside. Obviously, this is the dollar versus the CNH. So as this moves lower, the CNH is moving higher. We have seen quite a bit of strength, but the market's not paying attention to this more. It's now moving and shifting and looking more at banks and looking more at the BOJ and their recent policy. They've just gone into negative territory, and the yen's absolutely reversed on them. So there's a lot of volatility, a lot of movement in the market right now. Just try and pay attention to all these little indicators. The market is now shifting from area to area, and you just have to understand these things. I'm sorry for flipping around too much, but it seems as if we've got quite a few things to just go through. The yen, just like I said last week, we had a very, very bearish engulfing in the dollar yen. So you can see the yen very, very strong, which is very much a risk-off theme. But like I said, we've seen this overall dollar weakness, which is very, very interesting because dollar, the market might be trying to call the bluff. This, like we said before, the bluff that the Fed is saying, 3 to 4 hikes a year. Can they actually hike this year? The market says no. And in that kind of environment, obviously the dollar cannot rally if they feel that there's not going to be any rate hikes. So please keep in touch with these kind of markets. The last thing I just want to go through before we just close this up, obviously, is oil, just to keep that on our radar. Looking over at oil, not as pertinent, but very important because we haven't broken our inside week. This week we have, well, last week we left an inside week high at 34.18, a low at 29.40. The break of this is going to be super important, guys. Just keep this in mind. If we take this low out, most likely we're aiming to make a new low out for the year. Below these 26.80s, obviously that's not the low of the year. That was just a level that we pointed out, which worked. But the low is actually at 26.19s. Likewise, if we break this pattern to the upside, we're now taking out this critical low, these critical 2 weekly lows, and could put us back into this falling wedge pattern, in which case we could come up and test these highs here at 38.39. And if we do make a break of this to the upside, we could get a pretty decent little move. Other than that, I'd say keep an eye also on gold. There's just so much going on right now, but just you have to keep an eye on all of it. Gold is now approaching these highs here at 11.89. Super important highs, guys, because this is, if we take out these highs, we're kind of breaking this pattern of lower highs and lower lows. We've seen these lower lows, lower highs. We take out this area in here, we might be breaking a very similar pattern like we saw in oil, is this falling wedge pattern. And most likely, in most cases when these breaks, we've got a very big confluence area here. A break of this, we could see very strong reversal. And obviously that would play in with all the risk off theme. Now, not necessarily mean it's going to happen. We could obviously find some resistance here and come off. But just do bear in mind that we've been talking about this pattern since the beginning of the year, and it looks like maybe it might come to fruition. So yeah, that's basically what I wanted to go through for this weekly trading roadmap. A lot going on. One last thing before I go. We've got quite an important announcement coming out this week, so do keep an eye on our Twitter. Obviously, if you're not following us on Twitter, at Futex Live. My Twitter is at MVS_Futex Live. We've got a very, very important announcement coming out this week. I think some of you guys already know what that is, but do stay tuned and watch out for any hashtag PLT hashtags. So thank you guys very much for listening. Hope you guys have a great week. Make it a profitable one. Manage your money, manage yourself, your emotions, and just stay in the game, because when that setup sets up for you and you can feel that this is something you've been planning for, just hit it with conviction, and just hit it with as much conviction and size as possible. So great, guys. Take care, have a good week, and we'll speak again soon. Bye-bye for now.